بسم الله الحمد لله والصلاة والسلام على رسول الله وعلى آله وصحبه أجمعين. فأعوذ بالله من الشيطان الرجيم. بسم الله الرحمن الرحيم. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Assalamu alaikum wa rahmatullahi wa barakatuhu. It's a great pleasure to greet you again, once again, and it's an honor to present the 10th lecture on corporate finance actually. And we are reviewing the financial markets at first, and then we will be moving forward to our new topic, which is bonds, and later on bonds valuation later on. So first of all, we'll be discussing the financial markets. As we discussed that in financial markets, the securities are issued and traded. Stocks, bonds, and are good examples of the financial markets. Actually, in financial markets, we not only create the securities, but we also trade and sell the securities. We buy them, we sell them, and the good examples are New York Stock Exchange, Karachi Stock Exchange, and many other stock exchange are available in the world. Now we have two basic types of financial markets. Like we begin with primary markets or primary financial markets, where securities are or stocks are actually issued and created. Let's say we use the IPOs, which are through which we actually buy and sell these stocks which are issued for the first time. So then we have secondary financial markets or secondary markets, where the previously traded securities are actually or stocks are actually sold in here or bought in here, which is known as secondary markets. So this whole lot of process is actually completed by or done by the brokers. So brokers actually work in between the buyers and sellers. So they are in the middle. For example, here we have brokers, here we have buyers, and on the other side we have sellers. So broker function as an intermediary between the buyers and sellers, through which both can do their transactions successfully. So the buyer is looking for something to buy because he has access of liquidity, while the seller is lacking the liquidity. So the companies usually do that in order to have some cash with themselves for expansion of their businesses. We have stock markets, as we discussed before, where the ownership trades share of the ownership, we call it. And then we have the bonds market, where government is actually offering opportunities for the companies to secure money for financing a project or investments. In a bond market, which will be our topic, investors actually buy the bonds from another company, right? And then it is returned by the company later on with a specific interest rates, right? We have commodity market, where it's different than stock and bonds, because here on the commodities, natural resources, including oil, meat, gold, corn, they are created and they are, for example, they are sold in the commodity market, right? And we have, in order to have control over the prices of the commodities, usually they do it on futures in order to save their commodities in the future. The basic functions of markets are, for example, putting saving into more productive use. They're trying to use their money in a more productive way in order to save themselves. They do this in many ways. For example, provision of the student loan, business loan, etc. And determining the price of securities. Here the investments aim to actually create or make profits from their securities, and that is unlike the goods and services, which are determined by the law and supply. So here whatever is done is done on the basis on the financial markets, not as like in other things on supply and demand curve or basis. So it helps in creating liquid assets. Buyers and sellers actually make decision for selling or trading their securities at any time, anywhere, and they do it to sell their securities for making investments any way they want, right? So the last part is it actually lowers the cost of transactions, because when you want to search about a security company, a company which is offering stocks and bonds, then you do not need to spend a lot of time to buy information, because you are already in the market and you can collect the information and data freely and securely. And the last one is the importance of financial markets. Financial markets is actually a place where the participants, both the investors, daters, they are actually working regardless of their size, and they will receive proper treatment. They can, for example, many parties can trade their securities. Some parties buy them, some parties sell them. The parties which are actually having access of capital, they are trying to buy some securities, and the party which is lacking the capital, which is in need of capital and cash, they create the securities, shares or bonds, and they sell them in the market, financial market, in order to do their, for example, expansion, their investment, etc. The last part is the financial markets actually not only give us these two benefits and many more benefits, but it also provides job opportunities for people, because you need brokers, you need people for IPOs, intermediaries, you need people to, for example, some are buying, some are selling. So this whole thing is creating job opportunities for people. I'm not talking about the interest stuff, because interest is always there. In shares, we do not usually have interest as a stock, because we know that it is prohibited in Islam to trade in bonds in one way, because it involves interest, or we call it sud. Now we come to bond. As we discussed before, what actually bond is. We will be discussing bond valuation, its general relationships with the present value relationship. We'll be talking about bond pricing. We'll be talking about arbitrage-free pricing method, and then we will go to the next part, common stock, or the stock valuation, or the shares valuation. So beginning with bond, bond is something like a share, but a bond is actually giving you a fixed income. That's why it's called a fixed income instrument, right? Which represents a loan made by the investor to a borrower. Usually it is done by the corporations or the government, right? So usually the companies, the firms, government entities, municipalities, all of these are doing or issuing bonds in order to finance a project. For example, they have a road project, they have some other projects, they issue bonds in order to do the project completed, or let it completed on the due date that they have. So bonds actually have maturity dates at which the principal amount must be paid back in full or risk default. So when you are actually returning the bonds, there is a specific date for the return, and then you get back your principal amount, right? The amount, the real and the actual amount. So the governments and corporations, they issue bonds for example, as I said, for borrowing money, for having money from other people. They do it for raising funds, for roads, for hydropower stations, for dams, for other infrastructure projects on which they can gain some profit. So the basic purpose for bonds is to collect money, because when government is lacking money, they issue bonds in order to have money to complete their long-term projects, as we took example of roads and dams and etc. And there are a lot of examples you could come across while reading about bond project on Google. So you can Google it simply in order to understand that. Okay, so these government bonds that we talked about, and we'll be talking about it later on, they're actually traded in public, right? And some other bonds they are traded over the counter or in a private place between the borrower and the lender. So there are a couple of types that the bonds have, which we will be discussing later on. But only I was giving you a hint that some bonds are traded in public, whilst the others are traded in specific places, right, over the counter or in specific areas where there is only deal between the borrower and the lender. Okay, so why we buy bonds? That's a question that each of you may have. You see, as I said, bonds are issued by government, corporations, etc. The basic purpose is they want to raise money, right? They want to raise money in order to fund a project, to finance a project that they are planning to, because they are in shortage of money, and sometimes they issue this in order to have that money and go forward for the project, right? So while we buy a bond, we are giving the loan to the issuer who is issuing the bond, right? For example, I'm a buyer and the government is a seller. While I'm buying a bond, it means that I'm giving the issuer the loan, because buying a bond doesn't mean that it's always mine, right? I buy it and I give it back with the principal amount, as we studied before, right? So and both agree actually that the face value would be paid back to the original seller, which is the government, let's say, right? After a specific date, 1 year, 2 years, 3 years, it depends on the contract, on the maturity date, right? And while before it's given back, you are giving a specific amount of interest with the face value added, and that depends. It could be like, for example, semi-annual in each and every 6 months, and it could be, for example, year basis as well. So they are issued, and while they're not matured, between the maturity date and the issuing date, there is a specific amount of interest, سود، پیش از اینکه تاریخش ختم شود یک مقدار سود به همون نفری که باند گرفته او ریسیو میکنن. So unlike stocks, bonds issued by companies actually do not give you any rights, right? So you have no rights in the company whose bonds you have purchased. But what you have is you only have the interest receiving, and you can sell it back, but at the end of the day, it will have to go to the government back when it's matured. So if the company is in growth, in financial growth, a bondholder does not have the right to claim their growth, unless they only get is that they get their profits or interest, right? So it wouldn't matter to you the company is going on the right track or wrong track. The company is in profit or in loss, but you as a bondholder or as a bond temporary owner, you're never the permanent owner, because after the maturity you pay back or you give back the bond to the original issuer or owner and take back your principal amount, right? Okay, a bond does not have any name. So unlike share or checks, it doesn't have any name on it or in it. It is a general thing. If you lose it, you lose the whole money, right? You lose the bond, you lose the money, and that's for sure. So there are governments which issue price bonds which have no interest, and it only means you have some money holding with you. So whenever you are giving this bond to somebody, they would give you something you are willing to purchase, or you're willing to take cash on it. There is no interest in it. The basic purpose of this price bond is that you only have the price, you only have the money. You do not have money in cash in the pocket, but you have a document which can be converted into money and in specific places which are shown to you by the government. So it's the only bond paper has a value and no interest. The fixed value, for example, if the bond the value of the bond is 5,000 Afghanis, for example, while you are giving it to another person or a shopkeeper to cash the money back, so you can cash the money back, but on the same price which the bond is actually on. I mean, it's real price. You won't receive any interest or profits on it, because it's something like a current account. In current account, you can only have the money. There is no saving. There is no interest. But the good thing is that you can use it as a money anywhere, or in the specific places which are targeted by the governments. Okay, now we come back to the characteristics of bond, the features. Bonds, besides having the drawbacks, the cons, it does have some. They do have some benefits and pros as well. Okay, so the first thing in bonds we need to consider is the coupon or coupon payment, right? So actually, this is the interest rate paid by the bond. In most cases, it won't change after the bond is issued. So, for example, 10% coupon payment. The face value is actually something like the principal amount. It's the price. It's the real price of the bond. It's also known as the principal value, per value, and the face value of bonds differ. The usual face value that any bond has in the U.S. and some other countries is $1,000, right? So the value for the face value is this. Then I'm not talking about the for example, the coupon payment, the interest rate, or etc. I'm only talking about the real price. Now, each and every bond has a maturity date and expiry date. For example, a bond is issued for 2 years, so that's a maturity date for that particular bond, right? Okay, and when the maturity date is ended, then the seller will get their bonds, and the buyer will get their face value, the real value. Okay, and price is something like the real value on which it is sold, right? The price. Discounted bond. Some bonds are having discounts on various occasions. When there is a discount, it's called a discounted bond, right? It's still a bond, but there is a discount applied on it, which is less than its face value, right? For example, as we said, the face value of this bond is $1,000, but since there is a discount, then you are giving it you are giving it on 905,000, right? Because of the discount, $950, right? From 1,050 is discount, then you have 1,000. Now, the other part is the premium bond. The premium bond is the vice versa of the discounted bond. Here the bonds are sold on a much higher price than its face value, right? For example, the face value is 1,000, then in premium bond it is sold on 1,200, because it's a premium bond, it's a special bond, or it's a VIP, very important bond that you have. The last part is in the characteristics is the market yield, right? The market yield in fact is the interest rate, which is usually different than the face value, right? For example, 5%, 6%, whatever percentage is charged, but the market yield is actually the thing that we just discussed. Now we move forward to types of bonds. Same like the stocks in other parts, financial markets, bonds also have certain types. There might be more, but we only took 4 types which are the important ones. For example, we start with corporate bonds. Corporate bonds, that's from its literal meaning, it's a bond issued by corporations or firms. It is issued, for example, for debt financing in many cases, because bond markets offer more favorable terms and lower interest. So, while some people would like to have debt financing and they establish their businesses based on debts from other people, investments or money of other people, then they issue corporate bonds, right? Okay. The other part is the municipal bonds. Municipal bonds and government bonds, they are both the government bonds actually. These municipalities, when they have certain projects, road construction or any other project, they issue bonds called municipal bonds, right? Which are actually tax-free. Their taxes are exempted, and which give the investors some profits as well. The government bonds, on the other hand, they are usually, since it's issued by the U.S. Treasury, with usually the tenure or the maturity is 1 year or more. When the maturity is less than 1 year, it's called a bill. They call it a bill, right? When it's more than 1 year, they call it notes. And when it's more than 1 year to 10 years, it's called notes. While it's more than 10 years, it's called bonds, right? This entire category of bonds is issued by the government treasury of the U.S., and it is often collectively called as the treasuries, right? So that was the government bond, and its different types, almost 3 types. The last type of bond we have is the agency bonds, right? These are also issued by the government, and there are specific agencies which are owning these government affiliated organization. For example, Freddie, Fannie Mae, etc., etc. Okay, so that was the types of bonds: corporate bonds, municipal bonds, government bonds, agency bonds. The second last slide that we have is the bond valuation. Right now, we move to a very important topic after studying these 4 slides: what bond is, why we use bond, what are the basic characteristics of bonds, the types of bonds. We go to bond valuation. Now, what's bond valuation, right? In bond valuation, actually, we tend to identify or determine the bond's value, right, in the market, the value of bond in the market, and the bond actually is valued in the market. While we talk about a market, we talk about a financial market or a stock market. So in the stock market, you are able to buy or sell your bonds or stocks. Sorry. Okay. So the government or municipals, as I said, they both have bonds, but these 2 government bonds, since the issuance of the bonds and stocks all are related to the government, and specifically when it comes to, in terms of money, it deals with the central bank of a country, like the Afghanistan Bank and so many other banks that the governments have throughout the world. Then these bonds, the government and municipal bonds, are issued by the central banks, right? When they are issued by the central banks, they are distributed or given to commercial banks, right? Through commercial banks, the central banks or a central bank through commercial bank is distributing these bonds among the people. So central bank is the main authority, and the commercial banks are the distributors of these particular bonds to or amongst the people. So that was bond valuation. The last part is the methods. We will be discussing this method in the coming lecture, inshallah ta'ala. We will be discussing methods, general relationship, and there are some other methods that we will be talking about in coming class. We will be discussing about bond pricing, present value relationship. As you could see here, we'll be talking about arbitrage free pricing method, and these 2 or 3 methods we will be applying with couple of examples, inshallah ta'ala. I think that's enough for today's lecture, where we discussed the bond, the definition for bond, which is bought by the people who are having access of capital or money, and sold by people who are in shortage of money. They are issued by companies, municipalities, the government, or the corporations. They have specific maturity dates or expiry dates, where the principal amount or the face value is returned back, and they are used for by the governments for construction of roads and infrastructure, etc. Bonds are issued for the purpose of raising money by the companies, and bonds do not have any specific names on it. So if you lose it, you lose the whole thing. And this was some of the other parts: the price of the bond, the face value, the maturity date that we have already discussed. There are corporate bonds issued by corporations for debt financing. There are municipal bonds issued by the municipalities in order to have their projects done, and they are actually usually tax-free bonds. The government bonds are usually issued by the US Treasury. There could be other government bonds in different countries, and agency bonds are affiliated with certain agencies. And we discussed about bond valuation, how we evaluate the prices of the bond, and how it is done in the market. And we will be discussing the methods, various methods of evaluating a bond. That was all for today. In coming class, inshallah, we'll be moving forward towards the methods of bond valuation, and I hope the class is clear for you. If you do have questions, please do not hesitate to share your questions through the LMS or through Tawheed Sahib or through my WhatsApp number. Thank you for today, and inshallah we'll be seeing you again in the next lecture. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh.